All right, everyone, welcome back. Another episode of the Practical Prepper podcast. I'm your host, Nick, and back in the hot seat for another episode. Broke a lot of records with the last one for the EMP podcast. We have Andy joining us again, and today we're going to be covering the topic of inflation, everybody's favorite thing to talk about right now. Andy, how are you, my friend?
I'm good, glad to be back.
Hey, glad to have you. Thanks for taking time out of your schedule to do this.
Let's talk money.
Yeah, let's inform the American people what they should be doing, what they should be worried about.
All right. Well, first off, let me just get the disclaimer out of the way that there's no right answer. There's so many schools of thought on inflation and macroeconomics, and just like different schools of economic thought about how this plays out. Right. So, big picture, inflation is just the increase in prices over a given period of time. Mm-hmm. So, let's say a cup of coffee in 1920 cost 10 cents. Now a cup of coffee, depending where you are in the world, costs like $4 at Starbucks. Yeah. So, things get more expensive over time. There's a million different drivers that go into that, and there's quite a few different ways to look at it. I personally have my own opinions, and I am willing to bet that other people have different opinions too.
Right. So let's just start with, before we got started here, we were kind of hashing out some show notes and stuff, and we were talking about the Big Mac chart. Now, when you said that, I immediately thought we were going to have to explain what that is, because I don't know what that means, but it's actually exactly what you think it is.
So The Economist magazine, which is a great magazine, they've done this thing called the Big Mac Index, and they've done it since probably like 2000 or something like that. And every year they track the price change in a Big Mac from January to January all over the world. So every place McDonald's has a restaurant, they track the change, and then they also like mix and match and weigh it against other things. So they just came out with the recent Big Mac Index in the last few weeks for 2022 or 2021. But before they came out with it, I was part of a project that actually did our own study on this, because we wanted to see what it was, and they weren't moving fast enough. Mm. So essentially, the CPI, which is the basket of goods CPI, which is what's you see everybody on the news and the TV talking about, measures inflation. Mm. So they said in December it was 7%, then it rose to 7.5% in January of 2022. And so our team went down this road of the Big Mac Index, and we realized that the CPI, at least for a Big Mac, is 10%. So, for example, the price of a Big Mac was X in January of 2021. Now the price of a Big Mac is $7 for just the sandwich in San Francisco, $6.80 for just the sandwich in New York City, like $5.50 in Atlanta, and like $6 something in Chicago. Now, this is a 10% increase year over year. So you'll see that the CPI is not the best measurement of inflation, but it's what the Fed uses, and it's the popular method, and everybody knows it's not good. So the CPI is a mix of, they take products and services that people use every day, they being like the Fed, the Federal Reserve, and they put it all together and they say, all right, so these are, milk, bread, cheese, meats, services like, I don't know, oil change, and some other stuff. They put it all in a basket and they say, how much have these prices been raised month over month? So they're saying 7%, 7.5%. I'm saying at least 10%. And you'll see other economists have different numbers that come out. You'll see like coffee is up like 90-something% since January of 2021. Vehicles, because of the supply chain shortage, vehicles have gone up X amount, something ridiculous. Used cars are like 45%, I think. But all of this is to say that we've got this drastic increase of inflation. That's, now I'm going to go down a rabbit hole here, but this is my take on it.
That's what it's for.
There's a lot of other people's takes on this. So, since the housing crisis in 2007, 2008, the Federal Reserve decided to keep interest rates artificially low and keep pumping money into the economy through QE and things like that, quantitative easing, which is essentially just a bond buying program. They were even buying equities and ETFs in the open market. No kidding, there's a secret building in New York City that the Fed runs people who are like undercover buyers of ETFs, and they don't tell anybody, they don't tell brokers who they work for, and they'll go buy ETFs in the open market so nobody knows who they are, and they'll add them to the Fed balance sheet. Very interesting, very cool. But so they've just been pumping money into the economy, and they haven't been raising rates. So at some point, we're playing this game of musical chairs, and COVID hits, and hey, here we are. Like, everything is compounded. The snowball is moving at full speed, and now you got to pay the piper.
Right. Like we were saying earlier, it's musical chairs, and the average person will be left without the chair.
Yeah, exactly. Yeah. So the average person is not going to win in this scenario. The shrinking middle class is not going to win whatsoever. So you've got the Fed, who's been pumping money in since 2007, 2008, didn't raise rates, kept just throwing money into the economy. They've thrown so much money in the economy at this point that it just drives inflation higher, and nobody's measured it. Nobody's really paid attention to it until recently, until COVID. So then you look at things, and now the Fed has to backpedal and try to raise interest rates to slow down the economy. However, while that's happening, everybody's raising prices. So again, this is all just my opinion and my take on things. So what you'll see is in January, companies started raising rates because it's a new year. So they started raising the prices on things similar to the Big Mac, right? So $7 for a Big Mac right now. And then they might raise them more as the year goes on to match the rates of inflation and, cover down on things. Because as we know, if a company makes, 15% profit last year, they're not going to take, less this year. It's just not going to, that's not how things work. So they'll have to adjust their prices to accommodate for that. It is what it is.
So there's no going backwards.
There's no going backwards.
Yeah, they will never be like it was before.
No, so I asked a very smart friend of mine who runs a few companies, and I said, hey, if the Fed can get the inflation rates down and everything kind of balance out, do you think you'll lower your prices? Because he raised prices as well, just for this reason. And he said, no, because I also had to give employees pay raises, and they're not going to take a pay cut.
True.
Yeah, I mean, if everybody takes a pay cut for all the increase in wages they've had because it was hard to find people to work, so you had to pay them more, things like that, all of these compounding effects. They're not going to take a pay cut, so I'm not going to lower prices because I still need to make money, because I still need to be successful. This is capitalism. Let's go.
Right.
If I make 18% this year, I need to make 19% next year at least.
Yeah, it's already proven that they're willing to pay it.
Yeah,
they're still making the money. So why would I say, okay, I'll back it down?
Yeah,
it's not going to happen.
Yeah, there's no reason because your costs aren't going down.
I did read that, and it makes sense. So the last time that inflation really, really hit hard, it would seem that nobody under the age of 50 has truly experienced it in the way that it's going to be happening now. Like the build up to what is happening, no one's ever seen it as bad as it had been.
Oh yeah, exactly.
Yeah.
I mean, so that was like 79 to 80. Inflation was at like almost 15%. There was that was the like a gas shortage and things like that. It was right after we got rotated off the gold standard, and there was a guy named Paul Volcker, and he did this thing called the Vulgar Shock, where essentially overnight he had to raise interest rates overnight to stop this rapid inflation that was just going crazy, and it started a recession. So I mean, that's what happens in this scenario. There's a recession.
Yeah,
and I've been saying this to people for like a year and a half. I'm like, nobody has the intestinal fortitude to pull a Vulgar Shock and do it overnight. I mean, Jerome Powell, chair of the Fed, he just, good on him. He's trying to do the right thing, but nobody has the ability to be that hated in the world of social media overnight. It's just not going to happen.
Yeah.
So we would like to see that happen. Nobody has seen that happen below 50. Also, I was talking to some fund managers recently, and they're all, let's say, like mid-30s. These guys and gals are fund managers at banks and things like that. They've never been adults for a rising interest rate environment. So they've managed money in an environment where bond rates were useless. Nobody bought bonds. It was risk on all the time because you knew the Fed would bail you out. They don't know how to kind of diversify and hedge and figure out what's next, which is also kind of why we've got all these really, I'm not going to say bad companies, but you've got, PE multiples for companies that are ridiculous. I mean, you can look at Tesla as an example of Tesla, like before they could deliver cars. I mean, in that scenario, Tesla was not profitable for quite a few years. Their PE multiple was still ridiculous. The price to earnings multiple of public shares was still ridiculous. And they didn't make any money for their shareholders technically, but people were still betting on them. In a recession or in a rising rate environment or anything like that, you would be less likely to see fund managers or, any kind of financial advisor put money into a company like that that's not making money. So again, musical chairs, these small startups like the WeWorks of the world that did their, community EBITDA valuation nonsense. Yeah. They're not going to cut it.
No.
They just go the way of the dodo.
Yeah.
It's similar to maybe the dot-com bubble, but different scenarios.
So if we back it up to, we were talking about, obviously, it's the hot topic because they say that this was the all-time highest inflation, or it's been, you can go out there, you can Google it, you can see the headlines that say it, it's, 40-year high or something that they claim. Let's put some truth, or let's bust the myth.
All right, so let's bust the myth.
Yeah.
So 40-year high, probably not an all-time high, apples to apples. So the Vulgar Shock was 1980. That was at 14.8%. Let's say we're at 7.5% right now, according to CPI. However, if you personal opinion, 10% at least. But 1920, it was close to 24% inflation. So we're not at an all-time high, but apples to apples, we're getting there. We're creeping.
Yeah.
So, yeah.
Now and if we're just towing the line here, we're walking it, we're talking about inflation, what it is, what are the main drivers right now? Like, so what is causing it right now? And this is probably a huge, broad question. They could go on for hours, but just go with, in your opinion, what do you feel like
this is the part where everybody else has a different opinion.
Yeah.
Like, there's some people that might say that corporate greed is driving inflation because they are raising prices. Definitely can't weigh that out. That is a factor. There's also the fact that they have to raise prices because inputs are going up because COVID started this whole supply chain slowdown, and supply and demand is shifting in a way where things are becoming more expensive because they're harder to get. You can look at lumber to build houses. I want to say it was last summer, lumber skyrocketed the cost of lumber. You couldn't get it to build a house. It was astronomical. So that means the price of houses is going to go up because the builders have to factor in that increase in the cost of lumber. So it goes back to these base commodities getting more expensive just because of the supply chain crunch.
Yeah.
You can also the labor crunch also plays a part. My beef is the Fed piece and how they've just let this go for the last, however long, since 2007, 2008. It just compounds and it begins, and it's like a snowball. You kick it down a hill and here we go.
Yeah. People, they want to be pissed. You wake up and everything's more expensive and you're just, shaking your hands at the sky. You're cursing the world, the government. It's their fault. Why does everything have to be expensive? But if you think about it from the supply chain standpoint and the lumber example, it's basic math of how this should work. If that's more expensive and it's more expensive for me to get it, then for my service after I buy that to then build the thing that you want me to build is now going to be more expensive. Exactly.
So let's look at lumber, right? Let's say you order lumber from South America. You live in Miami, you order lumber from South America, and it has to get shipped to you in Miami, and you're building houses there. So COVID hits. The lumberjacks in South America who chop down the trees, they only, 10 of them can show up to work because the other 70 of them are out sick with COVID or social distancing, or they have to slow down in some way, shape, or form.
Yeah.
So because it now takes you longer, and then it's going to cost the company more money to get everything done. They're going to, some people might be out sick. Some people might, pass away, things like that. And then they have to get new people. The risk to the employees, they're going to say, I'm not doing this for, X amount of money. I need more money. Costs go up. And by the time it gets to Miami, you're paying, 3 times what you did the year before. So once that lumber gets to, the end stage of the house, you're the last one holding the bag and you have to pay more for the house. It is what it is.
Yeah. What about in the terms of gas? Now, is that supply and demand, or is that, because I feel like it could be supply and demand, but I feel like since that's what, war has been over since the beginning of time, is it has a lot to do maybe with politicking. So I
have a good friend who is an oil and gas guy down in Texas, and I'm going to butcher this because this is not, there is so much to the oil markets.
Oh, yeah.
I think there's, like you said, there's about 1 million different things. You've got OPEC plus, you've got the Saudis and the petrodollar. You've got, the U.S. as, a net exporter right now. We're also the number one net exporter in natural gas. But you're exactly right. So gas is going through the roof for a lot of reasons. Right now, it's going through the roof because of supply and demand, concerns about Russia invading Ukraine, and then Russia supplying nat gas or gas to Europe. And then we will, at the U.S., will then backfill Europe and hopefully sell them gas and natural gas at a higher price so we can make some cash. Mm. But, there's a lot of that. But it's a lot of supply and demand. A lot of OPEC Plus says we will only produce X barrels at X price. And that, they try to, it's not a monopoly. What's the word I'm looking for? It's more like a cartel of the price. Yeah. So, yeah. And OPEC Plus does include Russia. So they're the plus. Yeah. So, yeah. I'm going to butcher that. So feel free to get in the comments and explain how I'm butchering that somewhere. Yeah.
I'm just looking at the, we got a chart here that says price changes since January 2021. So I was just kind of going down the list and just trying to, I guess, crack the code behind some of them. So if some people feel like, oh, this is a mystery to me as why X is now more expensive. Like rent, for example, up 13%.
Well, yeah. So here's what happened. Remember when they said that landlords couldn't raise rent for a year and a half?
Yeah.
They were still incurring the costs. Some people didn't pay their rent. So you have to balance. Let's say if you're a landlord and you have 10 properties. You have to balance. I have 5 people who didn't pay rent for a year, but I still have to keep paying my mortgages on all these 10 properties.
Right.
So I then need to work, as soon as the government allows me to raise the rent again, I have to raise the rent to make the money up from the money I lost from the 5 people in the 5 properties who never paid me and then left. Yeah. And I can't do anything about it. So these are, again, COVID essentially pulled the curtain back. The Federal Reserve was doing this balancing act of turning on QE and turning off QE, calling it different names and kind of moving things on and off the balance sheet. As a matter of fact, they were doing it for so long that there was a pattern of the Fed would say, hey, we're going to raise rates or we're going to talk about it at our next meeting. The market would sell off. The institutional investors and institutional money would essentially hold the Fed hostage so the Fed wouldn't raise rates, and then they would just go back and forth, and they did that from 2017 to 2019 essentially. But then COVID hits and the Fed has no choice because of these compounding problems. Yeah. Just people aren't at work. I mean, it halted the economy until, in some countries, today. If you look at Turkey, inflation, so we're at 7.5% is what we're talking about here in the US. Last week or 2 weeks ago, the inflation rate in Turkey was 50%. It's chaos over there. Yeah. In other countries, it's chaos as well. Then there's still people protesting in the streets and in Europe and different places.
Well, that level of inflation, that's going to change the fabric of life.
Yes.
Everything's different.
Yeah, exactly.
Forever. That's crazy. And not forever, but
until there's a coup in that country. Yeah. And then Erdogan goes away and they find a new guy to run the central bank. But things like that, it's an international issue right now. We've just got to raise some rates and kind of manipulate some things that way.
The rent thing is really bizarre to me because of how during COVID, they extend the olive branch of you don't have to pay for this, but then return to normalcy, which is what everybody wanted. So you want to return to normalcy, but you don't want to have to pay the rent. So I just saw a photo of it, protesting in the street. I don't know if it was at Atlanta. I had pulled up here. There's a faction called Cancel the Rents. What exact? I don't understand because they want to, stop immediate, evictions and stuff like that. But what do you expect to happen? What do you mean cancel the rent? You can't just say, okay, you can't charge me to live here anymore. Well, it's not your place to live. That's why you're paying rent.
Oh, exactly. But so think about it. The same thing with, I might be getting off on a tangent here. And again, this is just my opinion, but it's the same thing with canceling student debt. Just, hey, people say, hey, I just write it off. Just make it disappear. Somebody has to eat that cost. Who's going to eat? The taxpayers are going to eat that cost during contract then. Same thing with the rent. However, me, if I'm not paying rent for 9 months, but I'm still somehow getting an income where I probably could pay rent, but if I don't have to, I'm not going to, because now I just have more money in my pocket to buy TVs, PlayStation 5s, new shoes, whatever.
Right.
But because there's no contract for me to pay rent and I have a loophole, I will take that loophole every time. That's human nature. It is what it is.
And a lot of loopholes have shown up.
Exactly.
COVID-19 was like the airing out of the here's all of the ways, and people took full advantage of it. We were talking about that on the last episode that I did about how people you didn't have to go. People were making more money staying at home.
Yeah, exactly.
And doing absolutely nothing. And so what would be the drive for them to be like, oh, I'm going to return to work outside of you just having a good moral compass and this is the only way that this country will continue to work, because if we all just sit at home and say, give me money, we're in deep shit.
We have a problem. But see, so that, like you just said, that brings up another great point about a driver of inflation. So people are making more money to sit at home. They're making like $60,000 to sit at home. They've got their stimulus checks.
You got more kids. They're just throwing money at you.
So then, in order for you to go back to work, they have to make it worth your while. So these companies are starting to be like, listen, all right, $25 an hour to mop the floors, cool, let's go. Whatever it takes to get you back to work, because I have a company that I need to run, and that's how I feed my family.
Yeah.
So that's, again, and if I have to pay for $25 an hour for the guy to mop the floor, then I'm going to charge you $50 an hour for the widgets.
Yeah. So or $50 an hour to eat, or I'm going to charge you, a steak dinner that was once $16.99 when you come back in. Well, now it's $28.99 because that guy back there mopping the floor. These are the dots. This is like just making it clear for somebody who just doesn't really, maybe they don't get why it's like this. These are the dots. This is the map. This is how we got here. Yeah.
This is definitely how we got here. And there's, like we said in the beginning, the guy mopping the floor for $25 an hour isn't going to take a pay cut. So there's no real reason to real reason to drop the price of that steak dinner.
Because if you show up and you're getting paid $25 to mop the floor, and one day they're like, hey, COVID's everything's going back to normal, so we're dropping your pay down to $15, he's going to throw that mop on the ground and leave. And
exactly.
So then we're right back to square one.
Exactly. You got to, we've, like you said, COVID exposed everything. It exposed this kind of Ponzi scheme house of cards that we were playing with. And here we are. Now we're in it. And now the question is how to get out of it. The answer to that question is also not easier. Not
many answers. Many angles.
It's going to take some time. In my personal opinion, and again, nobody listen to me because I'm a moron, but in my personal opinion, we're going to see a recession. You'll see the 100% sign of the recession is you see the yield curve invert, and everybody on TV will be talking about it on CNBC, and all the talking heads. They always talk about it all the time. Oh, the yield curve is about to invert. It's like the 2-year or the 2-year minus the 10-year bond rate. Mm-hmm. And when the yield curve inverts, it's a textbook sign of like we are now in a recession. It's, if you look up the yield curve inversion, recession is right next to it. It's a test question for everything. But so when that happens, things are going to get tighter. Prices won't go down, but people will just stop spending on frivolous things. So the middle class is just going to, it's like everybody used to say, all right, we're going to have to tighten the belts. We're going to have to eat this. We're going to have to not eat that. We're not going to go to Whole Foods and spend, $300 on a
no more name brands. You got to dial it back, and maybe you're not going to get everything you want when you go to the store type of thing.
You're going to have to start being a little bit, you're going to have to choose things, and you might have to budget a little bit. Yeah. Some people haven't had to budget in quite some time because...
Or ever.
Yeah. Because money has been plentiful.
Yeah.
They were sending you $1,000 checks in the mail. They were just like, cool, let's go.
Yeah, to do nothing. You're just... So yeah, this is going
to be... To reinvest into the economy.
Opposite of that.
So that's what's coming next. Coming soon.
Well, so I want to talk about and this, I know this gets said a lot, and obviously the listenership, there are people out there that are like, oh, I know why this isn't possible, but it's possible that there are other people out there that really don't understand why this is not possible. So we should just get it out there and talk about it. When people just say, well, why don't we just print more money?
Oh, we've been doing that.
Yeah,
we've definitely been printing a lot of money. And if you look at the money that's in circulation, I forget the statistic, but it's like in the last 2 years, we've printed more money than the last 40 or something ridiculous like that. And if you look at the chart just goes straight vertical since 2020. And that's the Fed was like, everybody's getting these checks. And how are we getting them? We're printing, baby.
Yeah.
We're putting the printer in overdrive. Jay Powell's just out there just with his hand, just cranking the printer, going nuts. But so why can't we just print more money? Monetary policy has been printing more money, and that's kind of what got us into this mess. Since 2007, 2008, we've been, and there's more to it, I know, but essentially we've just been printing more money.
Yeah.
We've just keep rates low, keep buying bonds, buying ETFs, open market operations, things like that, and keep the economy just growing and growing and growing, or perceiving that it's growing. So there's different ways, there's different levers that the Fed can pull from a monetary policy standpoint. It's not as easy as printing money. So you've got the overnight repo rate, which is essentially loans to other central banks, which they pay interest on every day. And somebody's going to have to fact check me on some of these because the overnight repo rates might be a little bit off on those. Mm-hmm. But then you've got bank reserve requirements. They can raise or lower those. So let's say, I don't know the exact numbers, but let's say Bank of America has to have, $5 billion on hand at all times, and they can't go any lower than that. Then that means they won't loan out less than that. However, the Fed can say, hey, you only need to have, $2.5 billion on hand right now. So that means they will then give out more loans and stimulate the economy that way. Mm-hmm. However, that may or may not work in this scenario. But that's one of the historic ways that the Fed has dealt with monetary policy. And right after 2007, 2008 is when they drastically changed that. I forget specifically what they did. So short-term interest rates, which is what we're talking about right now, the bond rates is the major thing because they've been so low for so long. Mm-hmm. And now when they increase rates of treasury bonds, that means, let's say rates have been like 1% or something like that for a long time. Now I think they're like 2.5% right now for a 10-year. But if you buy a bond, if you take $100 and you buy $100 worth of, or you buy a $100 bond, then you'll get 2.5% back in 10 years. So it used to be 1% back. So that's nothing. You could make more money just doing anything else other than that.
Yeah.
So now the goal is to have retirement funds, pension plans, ETFs, things like that, be enticed to buy these U.S. Treasury bonds. And then that way they can, you have these safe assets and you have your money in them. And in 10 years, the government they get theirs. In 10 years, they'll give it back to you, 2.5% or whatever. So what will happen then is you'll see risk off cycles where people start buying bonds and they sell off equities and stocks or other assets that are more risky than bonds because the risk outweighs the rewards, I think. So you'll kind of see that. So that's the goal right now of Fed policy to stop the money printing. Yeah, is the bond rate is what they're going for. And again, what they have done before to get us into this stuff was to stimulate the economy was QE and different forms of QE and buying their own bonds and doing open market operations, which was out there buying ETFs from their like secret office and stuff like that. But that was another way that they were just stimulating the economy.
So if you going along with all of this, so the printing of more money obviously results in the devaluation of the US dollar. Essentially. Yes and no?
Yes, yeah, it does. And they do other things to strengthen the dollar. The dollar is a weird thing. So
what is the I know it's you obviously don't want a weak currency, but what really is the the dollar being worth less than a dollar? What's the big deal behind it, other than trade, other than foreign
trade? Yeah, foreign trade is kind of the big thing. So you've got the international currency basket, which is made up of 5 different currencies. It's the dollar, the yuan creeped in there, and the euro, might be the pound. But anyway, so it's made up of those. But the dollar is the largest portion of that basket because the U.S. dollar is used internationally because it is perceived as the safest and most steady currency. It's, we're not going to, like Turkey, the Turkish lira, because of this 50% inflation, the Turkish lira, fell through the floor. So overnight, essentially. So people use the US dollar so that doesn't happen. It's very stable. And then you'll see that there is so much USD in circulation internationally that it's not just US companies doing deals, let's say with France, and they'll write that deal like, hey, we're going to pay you in USD. That's how this deal will be structured. It's also other companies doing deals in US dollars, like a French company doing business with a Moroccan company. They will also do it in USD because they know that is a steady value. I don't have arbitrage losses because if we do, if I'm a Turkish company and I sell something to Morocco and we say I want to use the Turkish lira, I'll give you, I'll give you 500 Turkish lira for this contract when the contract's over. Now the Turkish lira is worth absolutely nothing. So they've just lost, they've essentially lost all that money because their currency has fluctuated so much. So to avoid that, the US dollar is seen internationally as the standard because there's little fluctuation.
Wasn't it like a couple years ago maybe was it Venezuela where they were burning all of their money in the street to cause it to be worth absolutely nothing?
Yeah, there's actually Venezuela they use a lot of cryptocurrency that people in Miami run for them, and they'll send back and forth to get people in there so they can use it in Venezuela because their money is worth absolutely nothing. Yeah. And Maduro is just, he is who he is.
So the value of the dollar, it's a strange thing because it's like if I have physical money in my pocket and we leave this room and I ask the next 10 people, hey, how much is this worth? It's worth $1. Whether it's not worth $1 or it's not. Like here it says in 2021, the dollar was worth $1.06. 2022, the dollar's worth $1.10. But in reality, in the United States, it's just $1.
Yeah. I mean, start getting to exchange rates and stuff like that. It changes all the time, and there's like daily spot rates and things like that. But again, the power of the dollar cannot be underestimated because you can go anywhere on this planet and whip out a $10 bill, and you can get people will accept it. Yeah. If I go to China right now and start whipping out Venezuelan dollars, whatever it is, if I whip those out, people are going to laugh at me. Yeah. And they're going to ask that I bring in stacks of them to buy a candy bar. Mm-hmm. But I mean, I've been to China and I was over there and I had they have weird monetary policy over there. You only pay by the app on your phone or cash. And this was...
Or your teeth.
Yeah. I think they just recently went all crypto. But when I was there, you could go to the ATM and get cash or something like that. But I also had a bunch of USD and I could go to the store with USD and use it to buy things and people would accept it. Yeah. They'd be like, okay, USD, I can do something with this.
But is it like that? Like, it makes sense in China that it would be like that. But in other places, I don't feel like it's maybe like when I was in Europe or the Netherlands, I don't feel like it pools the same. It's obviously, it's a widely known and it's a respected form of currency, but obviously they just don't. It's not accepted.
It won't pull the same in Europe because they have the euro and things like that. And the euro and the USD they move relatively. They're not. It's not a 1-to-1 ratio, but they're steady together.
It's always the same.
It's like $1 to $1 to $1.30. Yeah. Like that. But point being, if you go there, you won't. If you don't have time to convert money, they will take it. Yeah. They won't turn it away. My Venezuelan Chuck E. Cheese bucks.
Yeah, they're turning those away.
Yeah, they're just like, no, man, go away.
Yeah. So if in talking about the level of inflation that we're at now, I know you were talking about the mythical 10%. That's where you see it going. So how bad do you feel like it's going to get in the U.S.? Again, this is another question with the same disclaimer. Many different angles, many different avenues this can be viewed from, but because obviously people don't want to just think, well, this is just going to keep getting worse and worse forever. Obviously it has a glass ceiling that will break. Balloon pops would come back. Yeah, this is just the ebbs and flows of throughout history, same thing. But how bad do you think it's going to get before pressure is relieved?
Okay, so there's a fund manager in Miami. His name's Cuppy, Kuppy. You can follow him on Twitter. Great guy. He calls this Operation Zimbabwe. Because essentially Zimbabwe imploded, and there's always the joke that Zimbabwe, they printed $1 million bills, and you can buy them on Amazon. It's you just put them up on your wall, right? So that, that's how much their inflation rose until it went, went to a very bad place. But I don't think we'll be full on Operation Zimbabwe. However, it's going to get bad before it gets worse. I think personally The Fed says they're going to raise rates 4 times this year. I think it was like 3.7 was the technical number. So I assume the Fed will raise rates 4 times. They might get through 2 of them before the market sell-offs get a little bit wonky, and then that's where the recession kicks in. I'd say sometime around midsummer, and that's when it's belt tightening time. Yeah. So in order to get ahead of that, you start tightening your belt now. You start saying, well, I don't need to spend money on frivolous stuff right now.
Yeah.
The nature of the beast. If I don't need it, I shouldn't buy it. I shouldn't be spending extra money on Amazon just because. Think about how many things, maybe this is just me, but I can think of a lot of money I've spent on Amazon for stuff that like sits in a corner of a room or in a box. And I just never, I've used it once. I'm like, this should go be a great idea. This is a great investment. I'll use this all the time. And I used it once and I've never used it again.
Yeah.
So you're welcome, Amazon. But the belt tightening should start now. Summertime is probably when we're going to see more of a legitimate recession. Because and again, this is just my personal opinion. I think it's going to take a few months for people to start to understand where these prices are going. Right now, home buyers in the last few weeks, they just raised the rates to 4%. I think it was at 3, they raised it to 4. But you're going to see people not, that takes another 100,000 or 200,000 people out from buying a home or whatever the number is going to be. So then those people who can't buy a home anymore because the rates are too high and they can't afford the mortgage, they will start to see, they'll start tightening their belt because they're understanding it a little bit better themselves.
Yeah.
But it's going to hit everybody a little bit differently timing-wise, and I think by summer we'll be all caught up.
But so you're saying summer's the time?
I think so. I think by then everyone will start to understand that everything's getting more expensive. They'll be like, I go to the I've gone to this restaurant for 6 months and I always get the same thing and I always pay the same price, and one day it'll just click that you're paying $10 more now for the same exact thing.
Yeah.
You're paying $20 for a breakfast. Something like, just that was $10 6-7 months ago.
Oh yeah. Well, the restaurant example I gave was a real time thing. I used to go to this little local restaurant all the time. They had a filet deal. You got a salad, a filet, and a baked potato. It was $16.99. It was Thursdays and it was super popular. You had to get there early. They only made so many. The guy would drive to Detroit each week and get these loins and bring them back. So the meat was super fresh. It was amazing. They got so expensive so fast, as you can go to the grocery store and see it now how expensive a fillet is. It's down now, but at one point it was like $33.99 a pound, and now it's so expensive that they just straight up they don't even do it anymore. It's not even like an option. Like you could pay this. They're just like that's it. Yeah,
the meat industry and the poultry industry took a huge hit. I know cattle ranchers and cattle producers out west. They had to get maybe it was a $1 billion bailout, maybe it was $100 million, I forget, from the federal government because, and I'm going to butcher this. Oh, good pun. But there's essentially like 4 producers or 4 plants or companies like Tyson's Chicken and 3 others that handle all this. And because of the COVID slowdowns, they couldn't produce fast enough. The ranchers weren't getting. They were telling the ranchers, they're like, well, I can only, I have to offer you less for your cattle because of these hard times that we're in. So the ranchers were taking less money, but they were still charging more money at the grocery store. And the ranchers were like, we're not going to do this. Like, what are you doing?
Yeah.
But because there's only 4 or so of these companies, they can make these rules because they have kind of like an oligopoly going on. So, yeah, so that's why that was. Because, funny story, I went to a Buffalo Wild Wings. And on the menu, I noticed they had new menus, so I go down to look and see what 6 boneless wings cost, and it says market price. I've never seen anything that says market price outside of fish.
Yeah, or when you know, like going into it, like I know this restaurant's going to have the market prices on there, which is it's expensive.
Those are restaurants you have to dress up for and get a reservation. I expect market price there.
Not Buffalo Wild Wings. If I walk in there and they want market price, I'm out.
We have some issues.
Yeah.
I had to ask, waitress, I'm like, what does this mean? She's like, market price, it changes all the time. I'm like, oh.
Yeah. Inflation's gone too far. They took Buffalo Wild Wings from us, and that's unforgivable.
It blew my mind, I gotta be honest.
Wow. That's insane. But I'm not surprised. So in talking about getting prepared and with the belt tightening and everything for summer, are there any other ways that you would, I won't say recommend, but that you could just loosely say that this might be a good idea if we're talking financial wise or something to get prepared.
Yeah, this is not financial advice. I'm a financial moron. Don't do what I'm telling you to do. However, I was talking to a friend of mine who's a fund manager out in Colorado, and we were just going back and forth about options to safeguard money in these kinds of situations. And it essentially came down to blue chip stocks, which is like, the Apples, the
old reliables.
Yeah, the old reliables.
That are not gonna.
Yeah, I can't even say FANG stocks. Like that's not a great one. But like the Apples of the world, things like that. Commodities, so oil, natural gas, copper. Dr. Copper is always a good one. And just stay away from the speculative stuff. There's a whole argument about crypto and things like that, but that's a whole different ballgame. I will say that I don't think crypto is as safe of an asset class as people would lead you to believe.
Yeah.
I mean, and I only say that because of the Canada stuff recently and about Trudeau taking people's wallets from them and like freezing their assets that way.
Yeah. The crypto that's supposed to be untouchable.
Yeah.
It's in a hard wallet or whatever that's not.
Yeah. So when you hook your hard wallet back up to the network and they have the number flagged because it's your wallet address and you can't do business with anybody.
And you don't understand.
Yeah. So I don't know if crypto is going to hold the same kind of value as it used to. Gold, everybody always says gold. I'm not a gold bug. I think I have my own opinions on gold. I'm kind of off the gold standard. Peter Schiff, Mr. The Sky is Falling. He's the gold guy.
Yeah.
No, I say blue chip stocks and commodities. Yeah.
Very well.
And have professionals manage your money. Don't do it yourself.
Yeah, absolutely. Well, I feel like we've just barely scratched the surface here on a topic would be impossible to cover it all and leave people being like, yeah, I know exactly what to do now, how to combat this. It's just it's a day by day battle that we're all going through and fighting. So, do you have anything else to add that maybe we didn't completely touch on?
No, I think we hit everything. I just want to say that, there's going to be some adversity coming. I mean,
yeah.
We'll be all right.
Yeah.
It won't be let me manage the doom and gloom and the fear, uncertainty, and doubt. It's not going to be like some flash crash sell off, like everything burns up tomorrow. It's not going to be that. It'll just be a gradual slowdown, and you'll start to see the stock market is not the economy, and you'll start to see the stock market match where the economy's been for the last 6 months.
Yeah.
So, but it's not going to be like go out and put your money in your mattress type thing, because obviously if your money's not getting you 7.5% interest, you're just losing money at this point anyway. Right. But there's no need to freak out. Just know that it might be time to tighten the belt a little bit.
Yeah, start living a little more frugally.
Yeah, just for a little bit
than normal.
Right.
Well, I appreciate your time. Thanks so much for talking to us about inflation. Hopefully you guys found some helpful little nuggets in there and start tightening those belts. So, all right, buddy. Thanks so much. I appreciate it.
Thank you.
All right, everyone. What a information-filled episode about inflation that one was. That one might be a 2 or 3 listen for you guys. Lots to unpack in there, lots to digest. Please feel free to let us know how you liked it and what other topics you would like to hear about. We're open to any and all suggestions. Also, thank you to our sponsor, Valley Food Storage. As always, you can take 15% off your first order with the code PRACTICAL15 at checkout. And that's exclusively for you guys who listen to the podcast and they make it all the way to the end. All right, well, until next time, I really appreciate it. Thanks.